And we are back, another week of What the F Happened, joined with my partner in crime, Mr. Snaggy, remodeling his office space here. But today we got a lot of stuff to talk about. Everything from, more recession fears. You got M2 going negative, first time ever that's happened. We can hit the plummeting M2, which means money supply in the system. So a lot of you are like, "Wow, M2, what's that? Is that some fancy new motorcycle?" Nope. That is the money supply. How much money you, me, and everybody else has in the bank under 100,000 banks and money markets. It's negative, folks. What else? What else does that feed into? Credit card debt. Credit card debt's record highs. So because nobody has money in their banks or money markets, they're using credit. And how can this all be sustainable? That's what we're going to talk about in today's episode of What the F Happened. We'll be right back after this. All right. Good morning. Good morning. Good morning. We are going live for What the F Happened. A lot of stuff going on in the news. Some of you have been paying attention. Some of you have not, but it has been a roller coaster ride, a true roller coaster ride in the markets. One day's down 380. I think it was 365. The next day's up almost 400. Then today looks like it's going to be down. It is literally the epitome of riding a roller coaster. And I just can't understand why people want to ride that roller coaster, because it's not a fun one. It's not like going to a theme park and all of a sudden you're on a roller coaster that's super fun and exhilarating. This is the roller coaster of your finances, and it's not one you should be riding. But you know what? The facts are in. Look at this chart. Now, I know TikTok and Instagram, you guys can't see this. It is the Dow Jones. Stephen, what does that even look like? Dude, that looks like something my daughter, who is 3, would be drawing on a piece of paper. I mean, it is literally like, folks, it is like these things going up and then just big drops down, then going up and these big drops. But the funniest thing is, this is the Dow Jones. It's completely sideways. So when people think the markets are going up, they're not. They're sideways. They've been sideways for over a year now. But everybody thinks they're going up. They're not. It's right there. What is that time frame? I know we're looking at August to August, a 1 year time frame. Folks, we've gone up a very small amount in a 1 year time frame, but holy crap, did you suffer to go up just a tiny wee little bit. How about any of you that have your 401ks? Do you have more money this year than you did last year? That'd be a question to ask, because after riding these roller coasters, these heavy fallouts in the market that I'm looking at that I know you two can't see. Yeah, so will not bow said the S&P is up 18% year to date. That means nothing when you lost money the year before. If you lost 15 or 20% the year before, 18% still wouldn't have even got you back to where you were the year before. 401ks are at record highs, measured against what? See, these are the questions I have to ask.
Yep. And don't forget the S&P. Don't forget the S&P. There's only 7 stocks that are having it positive. If you excluded those 7 stocks and only had 493, the S&P would be negative. And so if you're looking at that, like, what is your money invested in? If it's diversified, unless you're just all in the S&P where you're letting it do its thing, if you're trying to pick, if you didn't pick those right 7 in your portfolio, then you're losing money. I mean, so even those metrics are very misleading.
So let me just hit on this. Will not bow just said measured against what? Measured against, like, at what time frame are you measured against? You're just giving a year to date. Are you up over 3 years, 5 years? The thing you got to look at, if you're up, which I'm happy you are. I'm happy that 401ks are at record highs, but that's another reason to look at when to hold them and when to fold them. Are you going to continue holding into this market, into this economy, into the things we're going to talk about today? That's the real question. So will not bow. If you're looking at the charts, you can see you are at all-time highs. Kudos. Like, good for you, buddy. Good for everybody that's at all-time highs. When are you going to, it's not about how much money you are making right now. It's about how much money you're planning to keep. That's the name of the game, folks. That's the name of the game. Will not bow. I love your answers. I do. The S&P is up over 3 years and 5 years. Keep the money. Show me how to keep the money. Will not bow. Please. I will not bow, and you shouldn't either. But how are you going to keep that money? Because there's only one way to do it, buddy. If you're at record highs, how will you keep your wealth? That's what you got to get. The name of the game is market timing. Who's talking about market timing? You can't time the markets. Anyway, we're done with will not bow until he can tell me how he plans to keep the wealth that he's made, because he's saying, you know, we're up 3 and 5 years and we're at all-time highs and 401ks are at record highs. Good. Show me how to preserve and protect what you've made. That's what matters. That's what's going to matter. I'm not talking about market timing. You can't time the markets. Listen to Ray Dalio and his story. No one, I mean no one, can time the markets. I am not talking about timing the markets at all. Not in one bit. The markets could go higher. They could go lower. It doesn't matter. But there's one thing you cannot argue. We are at highs. And what does Warren Buffett say? Will not bow. What does Warren Buffett always say is the name of the game in investing? Buy low, sell high, and don't lose money. So that's the magic formula that I think a lot of people need to do. So let's just change topics. Stephen, let's talk a little bit about M2. So there's M1 and M2. I'm not going to get technical. They're kind of, you know, money supply metrics. You guys don't really need to understand it, but basically just understand this. It's the first time ever, right, Stephen? First time ever?
Since the 30s.
Okay, first time since the 30s, since the Great Depression. So the first time since the Great Depression, money supply is negative. M2 is negative. What does that mean? Well, that essentially means that accounts under 100,000 are in savings accounts, liquid accounts. I mean, there's a little bit more of a metric. You can Google M2. We could even put it up in the chat. But what you need to do is you need to look at that and say, how can that be negative? Well, it's easy. When people are out spending money, when people are out buying things, when the cost of everything goes up or your dollar becomes weaker, which is really what's happening with inflation, all these things lead to a simple formula, and that is M2. M2 is negative. There's the numbers right there. In first time that M2 is negative in the last 40 years. I'm just reading the data. The older data points to the last time this occurred being in the 1930s, which was right after or right during, depending on how you look at it, the Great Depression. So the whole thing you really have to understand is how. Well, credit cards are how. Debts are how. So during the last couple of years, really since the pandemic, even really if you go back to the Great Recession, after that is really where it started, credit cards and debts were fairly easy to get. The Fed kept interest rates historically low. Not only did they keep interest rates historically low, they pumped a lot of new money into the system. I mean, just through the pandemic, it was $5.1 trillion. That's a lot of money in through the banking systems, the central banks, and then distributed to banks, to institutions. I mean, it goes far and wide. We don't need to get into that. So when all that money went in, people got raises. When inflation started shooting up, which the Fed said was transitory, but obviously then realized, oh God, it's not. Now we got a big problem. So it's just the Fed always playing catch up here is kind of what's going on. And they're constantly, I like to say, they're trying to play God with the markets. They're trying to play God with the markets. They're trying to prevent a recession. And so far, they've been pretty successful at doing that. But at what cost is what you need to ask yourself. At what cost? So it's just like a balloon. You're just continuously just blowing the balloon and the bubble and the balloon up. Okay, you're just kicking the can, any thing you want to look at. Yes. I just had an awesome thing that just caught my eye. We need to go back to Keynesian economics. Keynesian economics is exactly what we need to get back to. Actually, we need to get back to Austrian economics if you really want to get down to it. We need to get away from this modern monetary theory economics. And that is basically print. Now, it's pretty interesting because by some accounts, it's worked. It has literally got us this far. And the markets should have fallen apart. But I guess that's what printing does. It pumps a whole bunch of money in and it artificially creates an environment that isn't real. It's a house of cards. It is the biggest house of cards we've ever seen. And then the question just comes down to, how are we going to handle that? M2 going negative is a real signal. The inverted yield curve, which is crazy inverted, is another signal. There's signs everywhere, signs. You all know the song. But not only that, credit card debts are at record highs. How can credit card debt be record high when savings are, essentially M2 money supply is negative? And that is because you're all employed, because we are all employed, because the unemployment numbers are so low. This isn't a a component of the government. Don't give either side of politics the pat on the ass for this one. This is simply they shut the world down for the better part of over a year. And then they opened it back up, and then they gave everybody raises, and everybody had to go back to work because the free money, the easy money, started to slow down. So that's going to change. It's already changing at the top. You're seeing lots of layoffs, but people have other places to go. So the Fed has said numerous times that they're going to basically have to go after employment numbers, and they are. But it's taking time because they just have so much money in the system. It's almost like a hangover that just won't go away, right? And that's what's going on. So the reason that we're in this situation is because the bubble hasn't burst. In a bubble, so this is one thing that a lot of people aren't going to like to hear, but recessions are healthy, okay? Market corrections are healthy. It gets out all the week, and it allows the markets to stabilize. Austrian economics, study it, okay? Austrian economics is the normal ebb and flow of the market, so there's a lot more to it, but they're healthy. And right now, we literally are drunk on printing. We are drunk on stimulus. And I don't mean drunk. I mean like shit-faced on stimulus money. And that isn't going to change until the bubble does burst and it kind of flushes the system out. And I don't want this to happen. Believe me, I mean, it's going to hurt all of us, but it's something that absolutely will happen. It's something that's just a matter of time before it does happen. But again, you can't time it. So that's why I always beg to ask the question. And will not bow is the one I was asking it to. Are you willing to ride this out? And if you are willing to ride this out, because he had mentioned earlier, oh, you got to play the long haul. And he said Warren Buffett always stays invested. But Warren Buffett's got teams that understand derivatives. He understands how to short the markets. He understands how to hold and do covered calls. There's a lot more to it. You aren't Warren Buffett. And you might say, well, then why do you always quote Warren Buffett? Because it's simple. That's why. Buy low, sell high, and don't lose money. You have, if you're going to ride this thing out, there's one thing you must understand. And I'm really speaking to a few folks here. You must understand the drawdown effect. You have to understand that. And you have to understand it really well. Because if you don't understand the drawdown effect, you won't understand what happened and why you should have taken the high road, why you should have taken the bridge instead of going through the ravine, through the creek or the river with the alligators, and then back up the other side. The bridge was the easier path. It doesn't mean getting out of the market, taking your gains off the table. Doesn't mean you can't get back in. You can get back in tomorrow. You could sell. Yes, there's, you got to trade plus a few days for settlement, but then you can get right back into the market. This isn't a permanent thing. This isn't a permanent thing. It's a bridge. It's all you need to do. And it isn't market timing, because I'm not making recommendations or suggestions of where you should put your money. I don't give a crap if you sell and you put it in cash, because then you're ready for the next opportunity, and you don't have to ride the roller coaster. You don't have to ride the markets down, and you don't have to deal with the drawdown effect, which is absolutely real. I get so passionate about this because I did this professionally for 16 years as an advisor. So I don't know if Will Not Bow is an advisor, but like I did this, and I did the opposite of what I teach today. The opposite, because that's what I was told to do. Stephen, you were also an advisor. Like, what do you have to say on all this stuff?
No, I'm with you 100% on all of it. It's just, it's wild to see it happening in real time. And it's wild to see the results of what's gone on over the last few years kind of all coming together right now. I mean, we talk about this financial house of cards, and it's held up by these little pillars. Let's say there's 4 of them, and these pillars are just going right now. They're just dropping, and this whole thing's about to tumble. I mean, I don't know how else to look at this data, Chris.
Yeah, there's a couple things, a lot of people, are saying if the bubble bursts, and we go negative, or will go into the negative because America has nothing of value. America has so much of value. We have lots of natural resources. Okay, we have the almighty dollar, which is still the reserve currency, which at this present point, even with BRICS and in Russia and China and all these other ones that you're talking about, all trying to trade oil in different currencies, it still isn't there. Okay, and the dollar, and just always remember the Fed's #1 job is to protect the dollar. So the United States of America has so much. You have to understand that. So it's not like we're just going to go negative. I'm just talking about money supply, which has nothing to do with the government. It has to, well, government clearly is spending a lot more than what they bring in, about 120% of GDP. But you just have to really look at this, folks. I'm just putting warnings out. You guys can do whatever you want. You really can. Like, shall not bow. He can do whatever he wants. He can keep his money in the market, but he should really understand, he or she, because I don't know, should really understand the drawdown effect before trying to do Warren Buffett's, game of holding. And also maybe then you should understand derivatives and how Warren Buffett actually plays the downside and protects the downside. Because Warren Buffett, if you haven't been able to tell, yes, he's a long-term investor. Okay, but don't confuse that with him understanding the core principles of how to preserve and protect the wealth that he's made. He doesn't just give it back, folks. He invests for the long haul, but for some reason, when the market goes down, does Warren Buffett or Berkshire, do they ride the same roller coaster you do? No, because they know how to play the downside. They know how to preserve and protect wealth. And because he wrote the book on buy low, sell high, don't lose money. You just don't hear about when he's selling. I remember back not long ago, I don't know if it was, I don't even remember when it was, Stephen. We talked about it a lot on this show. Warren Buffett was selling a lot of stocks, a ton of them. And he had more cash than he'd ever had in Berkshire. So when people say, oh, Warren Buffett isn't selling stocks, bullshit. He absolutely sells positions. He might not sell his core positions, but he's absolutely got traders and trading going on and following his core principle of buy low, sell freaking high, and don't lose money. Is Warren Buffett buying right now? No. That's the thing you need to look at. So when somebody says, oh, the markets are fine, they're going to keep going up, why is Warren Buffett not buying? Why is he sitting on hordes of cash? Because he buys low. It's so simple. So don't argue the facts of the matter, but understand everybody's different. Everybody's got a different risk reward profile, and you guys can do whatever you want. Aren't some index funds a much better aren't some index funds a much better investment than regular stocks? So yes, index funds just give you exposure to more. But here's the difficult thing looking at index funds right now. As Stephen said earlier, index funds, the Dow, you can look at any of them, the NASDAQ, the Dow, the S&P 500, pretty much any index. Really, they're being held up by a number of stocks, just a small number of stocks, about 7 of them to be precise. So when you really start saying, oh, index funds are better than regular stocks, are they though? Because really the indexes are being held up by a small number of about 7 stocks. Look it up. So it's really not too different, but index funds certainly are better for a smaller investor because it gives you a broad-based approach versus 1 or 2 stocks if you don't have much money to really diversify. But I'm not here to get into that stuff. That's not what this show's about. The show's about what's in the news and the facts of the matter, and these are the things that we got to really hit. So, Stephen, what questions do we got coming in over here from, I see a bunch of activity over here on YouTube. What do we got?
Yeah, just some good comments, coming in. Credit cards are starting to cancel. Lynn was saying credit cards are starting to cancel your cards for not using them. Trevor said, I remember credit card companies canceling unused cards in 2008 also. So just a lot of the same patterns that we saw. I love the passion, Chris. You remind me of how there's so many health, diet, do this, but it's not the best because we don't know what we don't know type stuff. It's not how hard we're rowing the boat. It's which boat you're in. A quote from Jim Rohn.
Jim Rohn. I love that.
The reason we are in this situation is because we go to work for play. Money literally costs 12 cents to print $100 bill. Add that up. See what you're really working for a week. Slavery never ended. I mean,
yeah,
a lot of people living paycheck to paycheck. I mean, couple missed weeks of work, and there's a lot of people that would be bankrupt and homeless, and it really does feel like that for a lot of people. I mean, I can kind of, I found an article that kind of shows some pretty interesting graphs, just showing some of these different trends that goes right along with all of this that we've been talking about. So this is from Zero Hedge, which is a financial publication, just talking about how the stimulus and consumption are fueling this economic resilience we're in right now. But how long can that happen? And basically saying, the economy's been marching forward, ignoring higher interest rates and consistent calls for a recession. A lot of credit goes to us as the people, but also Uncle Sam for showering trillions of dollars of stimulus. So you kind of take a look at some of these different graphs. So this is personal consumption growth rates showing signs of fatigue. Given personal consumption consistency accounts for over 2/3 of economic activity, it's worth exploring that state of the consumer to appreciate better what the economy may have in store. So this is just showing personal consumption, gross domestic product versus PCE. So you can see the upward trends, but watch this as we see consumption. So the blue line right here is what monthly retail sales looks like, that trend line going into 2020. Obviously, when COVID hit, it dropped way down. Everybody's locked in their houses. And then the government showered everybody with trillions and trillions of dollars and opened up the markets. And you can see how consumption just skyrocketed. you see this really steep increase where it should have just kept going, following the trend line. So you can see the green bars are showing excess sales up and above. But if we continue to look at retail sales growth right now, the green line is showing, that what we just looked at, but you can see how it's really dropping right now. So retail sales are falling 2 to 4% annually right now. So we had that huge increase with the stimulus, but now we're seeing that coming down and actually going negative when we take a year-over-year picture of it. A weekly private. So this is Johnson Red Book, a weekly private measure of retail sales confirms the recent weakness in retail sales growth. So you can see retail sales just really starting to drop. So if we see the spending, this money going back into the economy, that's just another catalyst that's going to really cause a lot of tightening and cause everything to start coming down. So
I think a really good video, Stephen, that supports everything you're showing with all these data. And where can somebody find all those charts if they wanted to see what you were just looking at?
That's on zerohedge.com.
So another thing I think that most all of you should do, it's really good, is just watch Ray Dalio's How the Economic Machine Works. It really shows all of this. It shows how debt, and we're talking about this, whether it's government debt or consumer debt, credit cards and so on, which are at record highs, how that plays into the bubble and the end of cycles. There's a 5 to 7 year cycle and then a 75 to 100 year cycle, which is we're at the end of both. As a matter of fact, we're over the end of the 5 to 7 by a couple of years, but because of printing. And also too, folks, I want to be clear. We talked about this in a prior show, but I want to hit it again. The printing isn't going to stop right here. The Treasury just issued its marketable borrowing estimate report, which shows the U.S. government intends to borrow over $1 trillion in the current quarter and another $852 billion in the fourth quarter. So folks, they're not going to slow the printing press down. So, when we talk about when does this charade end, again, you can't time the market, and I think, Coco over here was talking a little bit about index funds and giving a broad-based diversification using indexing. I've never believed in actively managed mutual funds. Even when I was an advisor, that is one thing I always definitely was against, is paying extra for actively managed mutual funds. Because if you look at history and you look at historical data on index versus actively managed funds rarely ever beat passive indexing. So kind of what he was talking about wasn't so much just the immediate indexing. He was talking about the broad base. And my cat is going to knock all this stuff over because he just can't. Here. Everybody say hi and say goodbye to the one and only Lazy Cash, who is making a complete mess of everything. Get out of here.
Meow, Lazy Cash.
My gosh, he's just excited or something. It's like giving a cat a Red Bull. Everything on my studio desk here is now on the floor. Anyway, back to the show here.
Yeah. I mean, in kind of keeping up the same line of thinking, we talked last week a lot about the downgrade of the U.S. credit. The credit of the United States. And now we're starting to see a lot of banks start to receive credit rating decreases. So this came out yesterday. Moody's cuts ratings of 10 U.S. banks and puts some big names under downgrade watch. So among the smaller lenders receiving official rating downgrade were M&T, Pinnacle, BOK, Webster. Major lenders, Bank of New York Mellon, U.S. Bank Corp, State Street, Truist Financial, Cool & Frost, and Northern Trust are now under review for a potential downgrade. So it just says, Moody's cut the credit ratings of a host of small and mid-sized U.S. banks late Monday and placed several others under negative review. And then let me switch over to this other one real fast. It just kind of talks a little bit about why we're starting to see this happening. So these charts show what has Moody's worried about regional banks, including U.S. Bank and Fifth Third. So a new issue highlighted by Moody's may cast a pall over banks. They've been forced to pay customers more for deposits at a pace that outstrips growth in what they earn from loans. So basically, they have all these low interest rate loans out for the last last many years, and now they're having to pay. Let's say they have a bunch of 3.5% mortgages or car notes out, and now they're having to pay, people hire for their deposits just to keep their money in the banks. Otherwise, people are pulling it and putting it in treasuries and these high yield savings and things like that. So banks are really struggling to keep money right now in their banks. So it'll be very smart to keep an eye on what's going on with these banks. So these banks start to fail again, we're in some big trouble quick.
Well, I almost think some of this printing that they're doing that I just read about here in that white paper from that economic report is some of that a component of bank failures that we're not hearing about anymore. Because I mean, I think so much is suppressed from the news. We don't hear everything that's going on. So it's sometimes oh my, see what I mean? He's got something going on today. You sit. But when you really think about it, it's just, I don't know, man. It all points to the same direction. I mean, there's a lot of printing going on, which basically means it's all got to get paid back. But if you really think about inflation, they're paying it back with weaker dollars. So inflation, when looked at by a government, is sometimes actually not a terrible thing. By the Fed, it is, because Fed's job is to control the dollar, maintain the dollar, and maintain monetary policy. But from the government standpoint, when inflation's running hot, they're paying debt back with weaker dollars. So it was really good for the U.S. government when inflation was running high and interest rates were low, because they were able to pay all their debts with weaker dollars. But they didn't do that; they didn't pay any debt off. But it's a pretty interesting way to look at it. And when you read some of these economic reports, I mean, like this particular economist, is just talking about stock PE ratios, which peaked in 2000 at 44.5. and are likely to go from their recent level of 30.8 back down to near their lowest level of 5, which we hit in 1921 and 1932. Then he's talking a little bit about, just the government and what's the healthiest path for the economy long term. And he's certainly talking that, what we need is a bottoming to cleanse the system. The debt-induced coma that we're in is what he's actually calling it. What's up, Tweety? Welcome back. We got some regular ones. We got newbie 526 coming in from Instagram, and this is kind of going back, but he's just confirming Buffett has sold out to having hundreds of billions of dollars of uninvested cash. So that just kind of goes into what we were talking about earlier, that yes, Buffett's a long-term investor, but it doesn't mean he's not selling at the top. He is not buying at the top. He's selling at the top, and that goes into it. Thank you, newbie S526 on Instagram. Thanks for that comment. I got lots of good comments coming in here on Instagram. We'll get to them, and a bunch of other good ones. We got Nancy coming in from YouTube saying, because we are at the top, just referencing all this stuff. Right. If you really just want the simplest way to look at everything that's happening, we are at the top of an economic cycle. Okay, I would even say we're off the top there. We're at the top of the market. I mean, we made new 52-week highs. Contrary to where the markets have been the last couple of days of up, down, up, down, up, down, we are at the top. And what does Warren Buffett say to do at the high or the top? Sell every time. Take your gains off the table. Here's another interesting thing, Stephen, that I saw in the news. You remember that company called WeWork?
Yes.
That company was a $40 billion company.
Yeah,
like they're everywhere, right? I mean, how many of you, listening right now have been to a WeWork, maybe rented from a WeWork, or just know what WeWork is, right? They did a good job with marketing. I mean, I know what they are. WeWork is about to go bankrupt. They're going to go from $40 billion to possible bankruptcy. There it is. WeWork from $40 billion to a going concern. WeWork warns of possible bankruptcy. So don't ever think a company that is valued at billions of dollars can't go bankrupt in no time flat. I mean, a lot's changed in the working space. People are working from home. WeWork gave like temporary spaces, which I thought were great, but I guess just I don't want to say it's a fad, but it just, I don't know, Steve, what would you call that? Just bad timing? I don't know. I mean, the pandemic didn't help them at all, and that's sad.
It's got to be a big problem. I mean, it goes into the whole commercial real estate thing. Like, people are leaving office buildings. They're not coming back to work. Companies that went, work from home, try to bring people back, kind of gave up and said, just keep working from home. I mean, there's a lot of commercial space and a lot of trouble in these next coming years.
Yeah. Tweety said, reminded us, we talked about it last week, that Yellow Trucking is also going bankrupt. And you can, we have different opinions about that. We talked about that a lot last week. Yellow Trucking, it's a massive trucking facility or trucking company. Some of that Yellow Trucking, I gotta ask, and somebody else brought this up last week and it made me really think about it. How much of that is them trying to break the union? Because there's a big union, the Teamsters union and everything else in Yellow Trucking. And I could have got that wrong with the Teamsters, but you get the drift, like heavily heavily integrated with unions, and how much of that play is to break the union. We'll know that, but it'll be too late by then. And hopefully it's not, because I'm pro unions, but I do think unions in some cases have far too much control and far too much power. And, in a free market, a capitalistic market like we are in here in the United States, unions can also go against that. And a lot of companies eventually will just break the union, and this is how they can do it. And, big companies like that are very well shielded from a liability hit. A lot of their monies are put in shielded, and they I'm not going to say they know what they're doing, and I could be completely wrong about that, but it just makes you think, right? It just makes you kind of look at it and just ask that question. Could that be what's going on with yellow trucking? And WeWork, we'll see. I mean, I don't think WeWork's been around long enough to really have what yellow trucking does, but it's definitely an interesting one to look at. Another one, Stephen, this is always your favorite topic. Mortgage demand drops again after FHA loan interest hits a 21-year high. But it's not just about mortgage demand. It's about how many people don't want to sell their house right now because they don't want to go from a 3% mortgage to a 7+% mortgage. And have any of you tried getting a FHA mortgage recently? Because I've got 2 houses, actually 3 houses right now that we're selling, rentals that we're selling to the tenants, all FHA. What is that? 7.09%. Do you know how difficult it is right now for a first-time home buyer, which is the case for 2 of the 3, or also just middle-class Americans to get an FHA mortgage right now? I'm not saying always, but right now it's a freaking uphill battle. Stephen, I don't know if you've dealt with this or if anyone else has dealt with FHA. So on the one house, they literally had the tenant, or us, it was a combination of the 2. They wanted the foundation of the house painted before they would give the mortgage. Just wrap your head around that, folks. The foundation of the house had to be painted before FHA would approve the mortgage. Since when does painting a foundation outside of cosmetics have anything to do with someone's ability to repay a mortgage? Please, someone help me understand that one. I understand like a broken window or a bad roof, which this house has a new roof, or things like that. But like, come on now. How much more difficult can FHA make it for new home buyers to get a mortgage to the point where sellers just don't want FHA like buyers? Like literally right in the listing, no FHA. Like, I mean, that's where we're going to go if you keep making it that difficult, and people, because that slows the closing process down. That makes it more expensive for the seller, because now the seller in most cases has to fix all this stuff just so the FHA buyer can move into a house that deemed by the FHA is perfect. There is no such thing as a perfect house, not even a new build. They all have problems, and they're all going to have maintenance, and they're all going to have things go wrong. Get over it. That's what it is. I think FHA has gone mad. That's right, Tweety. What the hell? I don't know. I don't. All right. What else do you want to hit on here, Stephen? There's so much news. I literally don't know where to go. And over the course of this week, we've had so many things come in. 1 in 5 Americans have inactive 401ks worth thousands of dollars. How to reclaim yours. We talked about 401ks and loans and withdrawals from 401ks being at record highs. Do you want to talk about that a little bit? Yeah,
we can hit that. I mean, when it comes to the FHA loans and some of these 401k ideas, some of these other things that we're talking about, it always reminds me of what Ronald Reagan said back in the 80s when he said, the 9 most terrifying words in the English language are, "I'm from the government and I'm here to help."
I mean, come on. How can you not like Ronald Reagan?
That always sticks with me. Because you see stuff like this come out and it's like, it's like shot chaser, you know what I mean? But like, this was from Bloomberg. To fix retirement crisis, give every baby $10,000. And basically they're saying, take that money and put it into the stock market. So, they're trying to come up with some really creative ways to really keep this stock market propped up right now. Yeah. And just give every baby $10,000 to put into a 401k type vehicle and let it grow. Right. That's going to work wonderfully, but nobody will just take that money out when they need it, right? That's what's happening right now. So to your point, Americans are pulling money out of their 401k plans at an alarming rate. So CNN, more Americans
CNN's always got the most legitimate, honest news, right? Sorry, just kidding, man. Just kidding.
Yeah, well, let's hope for CNN Business they actually do stick to actual statistics here. But more Americans are tapping their 401k accounts because of the financial distress. According to Bank of America, the number of people made a hardship withdrawal during the second quarter surged from the first 3 months of the year to 15,950, a 36% increase from the second quarter of 2022. Which are comprised, looking at employee benefit plans, comprised of over 4 million plan participants. It's a pretty troubling development if more people are resorting to making hardship withdrawals. I mean, Chris, as an advisor, most people's 401ks are so bleak. And it's why, we're told statistically speaking that less than 5% of Americans can actually retire at the age and the lifestyle that they want to. And because they're putting into these vehicles, they take it out at the wrong time. I mean, if anything, pulling money out of a 401k, this would be the worst time in history to do so. Why? Because we're at the very tippy top, the highest that the markets have ever been, ever. And that's all 401ks are made up of, are money that's in the markets. And so if we're following just sound, logical, common sense advice of buy low, sell high, and don't lose money, they're pulling that money out, meaning they're using that money for other things. They're not selling it high to continue investing. They're selling it because they're distressed financially and they're spending that money. And that's not how you invest. And so it's just every rule of investing and growing wealth is being broken right now. Interest rates are at the highest level they've been in how long? I don't even know, Chris. Interest rates are skyrocketing right now. And look what's happening. Americans' credit card debt hits a record, the United States record, over $1 trillion.
Think about the irony behind that.
Investments. They're putting money onto credit cards. Credit card rates are higher than ever. Interest fleeing your financial life will kill you. I mean, it's the whole basis of what we do with the infinite banking concept is keeping that interest in. And when it's crazy what's going on right now.
Yeah, I mean, it's just, credit cards at all-time highs during all-time highs of interest rates. I mean, that spells disaster, does it not? It's just like get in your car and drive as fast as you can at a brick wall. That's basically what you're doing there. I mean, it's just, like you said, it's common sense. There's so many good comments coming in from YouTube. I just want to hit a few of these real quick. And then I want to go back to 401ks, Stephen. Is there something else you want to hit here? Because that's pretty good right there. Look at that. Holy crap. That's current debt. I wish TikTok and Instagram could see this.
But again, we were trending that way before COVID. Remember, a lot of stuff we're seeing right now was going to happen before COVID hit. And then COVID hit and they pumped so much money in that it kept everything so propped up over the last few years.
But look at that trajectory, Stephen. Look at how long it took pre-COVID. It wasn't a straight line, but it was a inclining line. But how many years is that? That's from, I can't really read that.
13.
Okay, so from 13 right up to the pandemic, and then it fell off, and then it's almost like just a shooting straight line, straight up. So that's the impact of printing money. But from 2013 straight up through, that was printing money too. I mean, they never stopped the printing press after the Great Recession. Interesting. Well, thanks for doing that.
It took 7 years to climb about 200 billion. And then it fell 150 billion, and then it shot back up almost 300 billion in just a couple of years, 2 years. That's a big increase right there.
Yeah, and
look at that real fast. One other last thing: the average credit card charge is right now at a near record 20.53%. So $1 trillion is at around a 20% interest rate right now.
That's insane. How many of you would like to get a 20% or 20% return on your 401k? Anyone?
Math. How much is going out in interest payments right now at $1 trillion at 20%?
My calculator doesn't have. I don't have a calculator big enough to give enough zeros for that. But I mean, how many of you want 20% on your 401k? That's what you're giving away. But here's the thing: we're talking about sell at the top. Right? Take your gains off the table, buy low, sell high. So here's a strategy. We talk about this all the time. This is just we don't have to get strict or we don't have to get specific about investment tactics or strategies. Just hear me out. If you got a 401k and your 401k allows loans, you take a loan from your 401k. Okay. You can take 50,000 or 50%, whatever is greater. You take that loan, you don't go and blow it on a new car, a pool, or something stupid. You take that loan, you pay off your credit card debts, okay, from lowest balance to highest, and you just look at the interest rate you're being charged. So let's just say you took 50 grand from your 401k, you paid $50,000 of credit card debt off at a rate of 20%. All you then would need to do to make 20% on your 401k is take the exact same dollar amount you used to pay to the credit cards and pay it back to your 401k as a loan repayment. You'd be essentially doing the same thing as giving, instead of giving 20% away, you'd be making 20%. It's called recycling and recapturing, but you'd actually be making more than that, because not only would you be taking back the 20% you were giving away on the credit cards, you're also getting charged interest on the loan from the 401k, but the interest charge on the loan is going back to your 401k. So if it's 6% right now for the 401k loan and you pay off credit cards at 20, when you're paying it all back, you're essentially paying back 26%. So you guys all want to make 26% or something close to that on your 401k, take the money out of the stock market at the all-time highs, pay off your credit cards, take the amount you're giving your credit cards, pay it back to your 401k. I mean, shoot, this right here, this WTF, we just showed you how to make over 20% pretty much risk-free. Because unless you're going to steal from your bank and steal from your 401k, you're going to pay your 401k back, and you're going to pay it back with money you were giving away. So like, come on, man. Was that cool? Or is that just something all of you knew you're just not doing? I don't really know. But I mean, Nancy said it because we are at the top, right? So if you're at the top and you want to make 20% and you don't want to do it with any risk, shoot, pay off those credit cards. Because by statistics, looking at that chart Stephen just showed, I just got to bet some of you got some credit card debt. I'm just saying. So if you do, how much are you paying to that credit card debt? And let's focus on the fastest way to wealth. We say it on everything we do, including the wealth webinar that we do every single Wednesday at 1 p.m. Eastern, every single week. We say that the fastest way to wealth is through your own debts and expenses. Fastest way to wealth. Indexes, Netflix, or Nvidia, or Tesla, screw all that. Pay your credit cards off and pay yourself what you were paying the credit card companies. That's the best wealth you're ever going to get back, and that's the easiest wealth you're ever going to get back. Justin, or actually here, let me go up here. Nancy said, I would like to jump on a call and ask a question about investing in buying forest land to sell carbon credits. So Nancy, the place for that would be this afternoon at 4:30 for the Ask Me Anything happy hour, where you can ask all the questions. So Nancy, bring that question to Ask Me Anything at 4:30 Eastern today.
It's streamed right here on YouTube also, that show. And then this next comment, Chris, right here, and then we can go back to the crash one. But, Justin was just saying Money Tank was great this past weekend. Nice meeting and talking to, I talked to Justin a little bit, and he didn't have a lot of time to talk with you, but there's always next time. So he brings up a good point, because we do talk a lot about, what's going on with the markets, and, now's not the time to maybe throw a lot of money into the markets. It might be a good time to pull some profits off the table. But once you have the money off, you don't want it to sit necessarily. And I know you just talked a little bit about running it through a policy part against the 401k, but where do we find these opportunities? Where do we find places to deploy our money that's safe, things like that? And, of course, there's Private Money Club. You can hit on that. But really, I mean, just looking back to this weekend where we had our Private Money Club Money Tank event, I can't tell you how many different conversations I had about just amazing opportunities and deals and different ways to deploy and put out capital partnerships, different ideas that people have. And I can't say it enough, but these live events are just so powerful. And I know we have our high-end experience mastermind coming up in October also. So just thought maybe it's a good time to kind of mention, hey, if you missed Money Tank this past weekend, now might be the time to get a ticket to the experience out in Vegas. But you just want to hit that real fast a little bit, Chris?
Yeah, I mean, the experience is an event like no other event. How we created the experiences, I've been part of masterminds for the better part of a decade, and I've gone to many masterminds that I didn't like because I felt like I was just sitting through a seminar every single time. But this mastermind was created out of the best experiences that I made on the best masterminds that I've ever been to. Very expensive masterminds. I mean, masterminds I spent $60,000+ a year to be at. But the one thing I can tell you that I always remember from all those important masterminds that I've gone to and spent a lot of money for are the experiential ones. the ones where I went and did something that I can't duplicate, or did something with people that would be very difficult to duplicate. So what we set out to do with the Money Multiplier Experience Mastermind is to set out to create a very small, tight group of people. How many? 25 people. That's it. We never have more than 25, and we cap it, and we always sell it out. There's only 6 seats left right now, and it's in October 26th to the 28th. But this one we're doing in Las Vegas. Now, I know many of you have probably been to Las Vegas, but there are so many things to experience in Las Vegas with a group of 25 people that makes it so unbelievably memorable, because in Las Vegas, you have more things to do than just about anywhere else in the United States, because it's just the land of opportunity and the land of entertainment. So what we're actually going to be doing is something that I did at another mastermind. We're going to go race cars. We're going to go race Ferraris, Lamborghinis, Porsches. They got Mercedes. They got all sorts of crazy cars at this racetrack, but we've basically rented the place, and we've got a group that's going to be there. So think about the competitive nature of racing. Think about how that brings a team together when you're racing, and think about all the things you're talking about before and after you get in a car, an exotic sports car, and race it. That's what we're going to be doing. And then we're going to be going and doing a Beatles night out. So like there's that Beatles show. We're going to go as a group. We rented out that. And we got a whole bunch of other things and special speakers coming, breath work and all sorts of things in a group setting. These are experiential things. You're not going to sit in a room and listen to speakers. I'm sorry, if that's what you want, don't come to the experience. We're going to be out there doing things, making memories through experiences. So that's the experience. So if any of you want to join us, you can get to that. Stephen will put the link up. But Justin, thank you so much for coming to Money Tank. It was an epic event. It was just a lot of work. I didn't get to talk to a lot of people just because, like, every time I'd go out, I'd get caught up in conversations that took just too long. So next time, Justin, just come up, be bold, and just step into the conversation. I think that's the best way to say it. You're right, Kath. It's an adult Disneyland. 100 adult beverages. Yes, well, adult beverages make for good experiences as well. So with that, I want to hit on just a few other things here, a few other comments that came in. Let's see. Yeah, so Nancy was talking about yellow. Let's see, mortgage. Don't see how anyone can. Nancy's saying, I don't see how anyone can get a mortgage right now. That's ridiculous with FHA. Well, Nancy, it is very difficult to get a mortgage. There's a lot of people struggling to get mortgages. And you know what else is really difficult now that we're on the mortgage topic? With where pricing of mortgages are, with interest rates being high, it's not just hard for individuals to buy a house, which is also playing into the demand. Okay, there's so much demand, but it doesn't mean that demand for housing means people can actually buy houses, because if they're going to banks, they got to literally be perfect on paper, and many aren't. So that's creating a massive opportunity, an opportunity people like Jeremy Davis, who was at our event, or Pace Morby with sub 2 are really gathering and capturing because of the sub 2 or the creative financing. Because if people can't get a mortgage, what other ways can they actually buy the house? Well, creative financing is a way. Not giving a pro or a con against that. I'm just saying it's creating all sorts of different opportunities. But it's this demand thing isn't just because there's a lot of people that want to buy houses, which that's part of it. It's also because a lot of people can't buy a house. It's also because a lot of people don't want to sell their house, and that's not going to end. But it doesn't mean that real estate is going to continue to stay at these prices just because of demand. Because again, pricing has to come down on real estate, or there has to be way more creative financing. There's got to be something that gives. And my guess is the price is what's going to give, because that's always the easiest. If a seller wants to sell a house, they're going to have to reduce the price to come down to what the demand can actually afford. And as we get into this next cycle, which is where the Fed probably will raise interest rates one more time. That's my speculation or my opinion. And then after that, we'll probably stay where we're at for a little while. And then when the recession kicks in, when things start falling apart, which indeed they will, mark my words, you'll start seeing it probably this year, maybe definitely into next year. Again, I can't time it, but that's just the forecast. And when that happens, the Fed will start bringing interest rates down. And when that happens, it will open some of the floodgates for some of these, but unfortunately, it will also mean we're going to be opening the floodgates in a time when a lot of people are losing jobs. Now, can you get a mortgage when you lose your job? No. You more than likely can't get a mortgage when you lose your job because you don't have an income. These are all things to factor. Shauna said there's 8 tickets left. I thought that there was only 6, but there's 8. A lot of people talking about coming, but you got to get your ticket. Yeah, exactly. A lot of people like to wait till the last minute. Unfortunately, the fact of the matter with the experience is there won't be a last minute offer. it will sell out. There's only 8 tickets left. So think about that. If there's 8 tickets left, that means there's 4, because usually people that go to the experience bring a significant other, a spouse, or a business partner. So there's really 4 tickets left, because most people are going to bring somebody with them. Let's see, 20-year plus high rank Army. I'm just reading the rest of these here. Yeah, all right. So we got some great comments coming in, but Stephen, what else do we want to hit as we kind of close this down?
Somebody was asking, I think we kind of skipped over it, but it is a good question just because it is so relevant on people's minds right now. But what happens with a whole life policy and these insurance companies if there is a market crash? What does that look like? Is the money safe? How will that happen?
So that's a great question. I mean, what happens to insurance companies when everything starts falling apart? You really can go back and look at the Great Depression. You can go back and look at the Great Recession. You can look at the dot-com crash. Insurance companies actually usually thrive during economic slowdowns. And why would that be? Well, if you look at a balance sheet of a mutually owned insurance company, not a publicly traded so much, but a mutually owned, they have very, very little exposure to stocks. And they're always playing the long game. So the long game typically means they're buying long-term debts. Now that could be AAA rated or AA rated, whatever they're buying, corporate debt, okay, which is debt, it's bonds, or treasury bonds. Now, I want you to think about bonds right now. What do you think insurance companies have been doing for the last couple of years as interest rates have gone up? They've been gobbling up treasury bonds. Why? Because the yields. They're buying future yield payments. They're buying into this high interest rate cycle. And because of that, when everything falls apart, insurance companies are going to be positioned better than just about anybody, because they're going to be getting paid interest rates that nobody's getting paid that was playing the now game, because they were playing the future game. So almost every other economic fallout or every other recession or depression that you can look at, mutually owned life insurance companies have thrived. And they've thrived because insurance companies, unlike banks, have all the money. Banks have your money. They don't have their own money. They have very little of their own money. It's called tier 1 capital. Look it up. That's their money essentially. But insurance companies are getting premium payments and premium deposits every single day. So they've got lots of money to deploy. So think about this. If you got all this windfall of money coming in all the time, plus you're sitting in incredibly lucrative, safe, conservative, guaranteed by the U.S. government type of investments, and you got a lot of loans, because insurance companies historically have lent a lot of money in first lien position. What do they do when the market falls out? They buy low. They gobble up real estate. They gobble up anything they want at ridiculous prices. Why? Because they've got the money, because they were prepared to take advantage of the situation. Like I keep telling all of you to get prepared, get ready for what's coming, because it will be the greatest opportunity for most of us in our lifetime. For those that aren't ready, though, those that are out there spending money like it's 1999, those of them that are racking up the credit cards, whatever you want to say, thinking, oh, I got a job, I got a good income, I'm just going to live my life, tomorrow's not guaranteed, blah, blah, blah. Well, one thing is guaranteed. If you live that way, when this happens, it's going to sting. And I don't mean by like going out in your backyard and you step on a honeybee, that kind of sting. I mean like you running through the woods and you knock down a hornet's nest. That's the kind of sting I'm talking about. Can you all just reference what that would feel like? It would suck. So don't get stung by the hornet's nest. You want to play the safe high road. Take the bridge, folks. Don't play with the markets. Be very cautious with stocks right now. It's at a high point, and I can't see how we will make and sustain higher levels. I just don't. And that is not timing the market. That is just purely logical, based on facts that you can see every single day, no matter what news station you open, no matter what you are looking at. It is not hard to see that we can't maintain where we're at right now. So I think that's really something that all of us really need to focus on, and then make some strong and hard decisions, because some of the decisions, Shauna and I talk about this all the time. We got a couple clients that, have and are highly influenced by their financial advisors, and their advisors are telling them to stay in the markets, ride it out. You're in this for the long haul, which they are not in this for the long haul. Matter of fact, they're both essentially quote unquote retired. So you tell me, how are you playing this for the long game when you're retired? You're really not, right, Shauna? Like, can't play the long game when you're not playing the long game. Like, and their advisors have them literally in a head-on collision right now. they're headed for a head-on collision. And it's easy to see. I just looked at it and I'm like, this is not going to be good. But it's just, you have to decide who you're going to listen to. I'm not trying to sell you anything, folks. I'm not trying to manage your money. You're not going to give me your money. You're just doing this because you're starting to put logic in front of emotions, and you're starting to take and listen to the right person, which is you and your gut, versus listening to someone that's making a paycheck off you every single month because of the fees on the managed portfolio that they're doing. Like, come on, this is not difficult. That's why you're getting bad advice. Somebody's getting a fucking paycheck. Wake up. I should say, wake up, America. It's just not hard to see. It's not. Good morning, David and Dorothy. How are you both? It was awesome. They were at Money Tank as well. So here's the deal. 1 o'clock this afternoon, folks, 1 p.m. Eastern, okay, 1 o'clock. We've got the Wealth Builder Group coming on. If any of you have ever wondered why the wealthy and the uber wealthy, the billionaires and all the families that you know so well, why they don't pay as much in taxes as you do, it's not that they're doing anything illegal. They're playing right into the tax code. We're doing an entire hour and a half with Suleiman and the Wealth Builders Group to talk to you about 1041 tax planning, complex trust structures. But for the first time ever to our audience, we are also not just talking to the really wealthy clients of ours. We are now talking to the majority of the clients because they have figured out how to create a mini trust structure that will play into and allow you to basically control your taxes legally, just like the wealthy, and also protect your assets legally like the wealthy. Own nothing but control everything. But now, for the first time, it's at a lower level. I think all of you are going to love it. It's at 1 p.m. Go to chrisnaugle.com. So chrisnaugle.com, go to Wealth Webinar and register. It's totally free. Okay. And for any of you that are already registered, awesome. You will get the recording. And any of you that do register, you will get the recordings of it. Or actually, I might have put my foot in my mouth. I don't think we're allowed to record these. Maybe you won't get the recordings, but how will you know unless you show up? So that's the best way. Let's see. Tweety said buy after they split. I think they're talking about stock splits. You had to sell some and they haven't split in a long time. The markets are maxed out. Yep, Doc, that's absolutely correct. The markets are certainly maxed out. But anyway, go ahead, Stephen.
One kind of thing to kind of end on a little bit here is just, there's been a lot of talk in the stocks market in corporations on ESG, the whole environmental, social governance scores that they put out, which have to do with, all kind of like the social
scoring.
Political stuff, right? And so there's been a lot of talk out there about how it's used as a way to kind of like hammer these corporations into forcing certain ideologies and political agendas onto people and onto companies. And we're starting to see that kind of backfire in a number of ways. So it just came out yesterday that first off, the S&P is dropping ESG scores from debt ratings amid scrutiny. So they were issuing a 1 through 5 rating. And, there was a lot of stories coming out how like Tesla, which is an environmental golden standard compared to, what they're trying to do with everything, was receiving very low scores compared to some of these other companies that are just absurd. So there's a lot of like controversy going on with it. And, should stocks be looking at stuff like that? So both happening yesterday, the S&P drops the use of that, as well as America First Legal has filed a very large lawsuit in federal court against Target over its misleading statements to shareholders about its monitoring of ESG political social risks. And it resulted in a $12 billion loss in its recent promotion of some of that LGBTQ type stuff, propaganda to children. And it's just saying in 2022, 2023 proxy statements, Target assured shareholders and investors that the board was monitoring for social and political issues and risks arising from the company's ESG mandates. So we're just starting to see that kind of reverse course a little bit, and that pendulum swinging the other way and kind of going back to, okay, let's look at what really impacts a company and its stocks and its shareholders. And, let's focus on that as opposed to a lot of this political bullshit that's out there, so to say.
Well said.
I had a 2-minute video. I don't know if you want to end it with that, or if we want to kind of bring that in for next week, but it was Joe Rogan and Post Malone just talking about digital currency and it's kind of relevant to how Fed Now just launched, a few weeks ago, and kind of that push towards that digital currency. So maybe we start off with that next.
Do that video up, and just for anybody, we didn't get to your questions because there's a bunch. We got questions about Tesla. We got questions about land. We got questions about videos. About paying monthly bills. Come to the Ask Me Anything at 4:30, and we'll answer all those questions because we are over time here, and we want to make sure that we are true to the 1 hour mark. So, Stephen, let's roll that 2-minute video with Mr. Joe Rogan. And here we go.
So how do you feel about the government's digital currency that they're working on?
No fucking way. No way. That's what I think. I think that's checkmate. That's game over.
That is fucking checkmate.
Because if they apply that to a social credit score, if they decide somehow or another that you need some social credit score system and it's for the benefit of society, and they outline that they can, track your behavior and your tweets and all your things, and you get a score. And if
already doing that, they just haven't released the fucking report cards.
Well, they don't have the kind of freedom that they like.
They didn't send the report cards home to the parents yet.
Right.
Everything is already imprinted. Everything is already tracked. Everything is already there.
But
we just haven't given it.
They just can't control you to the same extent that they would like. And what they would like to do is to be able to strip you of your money and to be able to lock you down and to make sure that you comply so that all the other people also comply because they don't want to be stripped of their money. They don't want everything they work for just be taken away instantly overnight and be powerless. No one.
All right, I'll stop it there. You guys get the idea. It's happening in China right now. You see a lot of stuff coming out with the different social credit scores and everything like that. So it's just a matter of, do we want our freedoms or do we want supposed safety? And something to always keep in mind, as we move forward when it comes to controlling our wealth, controlling our future, controlling our freedoms. And that's what this show is all about. And that's what we try and share every single day is how to stay in control of your money, stay in control of your future, and provide for you and your family in the best way possible.
Love it. Well, hey, we'll see a bunch of you this afternoon at 1 p.m. for the wealth webinar. Go to chrisnaugle.com. If you've already registered in priors, yes, you do have to register again. It's week by week. And also 4:30 p.m. Eastern. If any of you have questions we didn't get to, like the ones about BlackRock, the ones about Tesla, land, and all that, bring them to Ask Me Anything Happy Hour at 4:30 Eastern. And that streams on StreamYard. So you'll be notified because you made it here. So you'll find it there. But if you're over here on TikTok and Instagram, you got to go over and subscribe to my YouTube channel at The Chris Naugle. Thanks everybody for joining us for another week of What the F Happened. We'll see you next time.